Is it time to forget about investing and just focus on paying off our mortgage? Take a listen to this clip.
Part of the reason that you've been so bullish on equities for many years at this point is the interest rate environment. Yeah. You've looked at interest rates and said interest rates are gravity on stock prices, and when interest rates are so low, stock prices inevitably are going to climb.
It is gravity.
That's Warren Buffett discussing his thoughts on interest rates and how when they rise, they make safer investments like bonds more appealing, and that in turn pulls down the value of other assets like stocks. Bad news for their expected returns, and at the same time, it makes debt more expensive, which is concerning in this case for mortgages. I got a comment the other day asking about this decision, and it got a load of likes. And since then, I can't stop thinking about Sandra Bullock. You see, in 2013, she starred alongside George Clooney in a movie called Gravity. The film is visually stunning, if not scientifically questionable. But if there's one thing that I remember about that movie more than anything else, it was Sandra Bullock's pay. You see, she took a slice of the equity of the film. She bet that taking a portion of the film's takings would pay off for her, and she was right. The movie didn't flop, and it's said that she earned $70 million from that one movie. When faced with Gravity, she bet on equity and she won. She also got $20 million up front for the movie, so really she wasn't going to lose either way. But now that Gravity's arrived and interest rates are rising, do we copy Sandra? Do we bet on equity? Not in the form of a slice of a Hollywood blockbuster, but instead the equity that forms the value of our homes.
Rate at which you're going to be able to get your next fix has gone up very substantially in the last 6 months.
And it's a rude awakening right now with the increase in rates.
6.7% is what you're looking at now.
It's said that Isaac Newton first labelled gravity as gravity. I mean, we all know the story about that apple hitting him on the head.
It's a run by fruiting.
But it's his third law that I think applies today. For every action, there is an equal and opposite reaction. If the force or action in question is interest rates, then since 2008, where we've had record low interest rates, the response or the reaction to that was asset prices floating away to record highs. But as central banks around the world have started to jack rates up, the opposite reaction we've seen can only be described as violent, as this gravitational pull just pulls them all back down to earth. Now homeowners face the reality their mortgages will cost them hundreds more a month. Crypto lies in tatters, and the pain inflicted on your portfolio of curated companies is comparable to a kick in the George Clooney's. And like anyone who's ever been kicked in the Sandra Bullock's nose, the pain gets worse over time. Rate rises look set to escalate, with the market predicting that the Bank of England base rate could be as high as 5.5% by the end of July 2023. From a pure numbers perspective, if you're on a 2% deal at the moment with the UK average home, you're paying around £1,057 a month. If when you come to remortgage, the rates are closer to 7%, you're looking at £1,903 a month. That's an extra £900 a month for the exact same home. Quite simply, that will just wipe some people out.
You just can't do it.
Now on face value, it might seem like an obvious decision, just to pay down your mortgage debt as it gets more expensive. But in reality, it's far from simple. There's so many moving parts and variables that need to be considered here. Your own personal financial circumstances, your risk tolerance, and just what makes you happiest. I can't answer these questions for you, but today I'm going to give you some of the pros and cons of overpaying your mortgage versus investing when interest rates are rising as they are. And at the end of the video, we'll discuss a strategy that might just cover all of the bases and might be a good way for some people to go. Right, let's start with the pros of overpayment. First up, the guaranteed return. In the past, this decision was a lot easier to make because, to put it simply, the guaranteed return you got from paying off your mortgage was a lot lower than the expected return that the stock market would give you. Essentially, mortgage rates were so low that the return you got from paying it down wasn't really all that worth it. Now rates are rising, this guaranteed return you're getting from paying down your mortgage to many may offer an attractive return. If you remortgage you now on a 5% rate, you might sit there going, hold on, that's actually quite a decent return. And I'd much rather get that guaranteed return than take my chances with the market, especially when forecasts are predicting that global markets will return less in the next decade than they have in the previous. But please bear in mind, in 2008, they forecasted that investment returns would be lower. They thought we were going to have a
double dip recession.
It didn't really pan out as they expected, and returns over that decade were really strong. Forecasts can often be wrong. But really, central banks around the world actually want you to have this conversation with yourself. Interest rates are on the rise in order to combat inflation. What that means is they want you to stop spending. They do that by making saving and paying off debt look more attractive. So essentially, by raising those interest rates, they want you to sit there and go, should I be paying off my mortgage now instead? The next benefit is access to lower rates. The interest rates that you're offered by lenders are normally influenced by the amount of money that you can put towards the purchase of the home or how much equity you already have in your existing home. The best rates typically become available for those who have paid off more than 40% of their home, home, but you'll see better rates at anything above 15%. The next point is payment holidays if you struggle. While it's never guaranteed, it can be the case that those who make regular overpayments to their mortgage are more likely to be accepted for a payment holiday if they were ever to struggle in the future. So if you're sat there worried about the fact that when it comes to remortgaging time that you won't be able to afford the payments, then overpayment now might mean that you're more likely to carry some favour with your lender. But I do think there's better ways to approach this than banking on the ability to get a payment holiday, and we'll cover that in a second. Finally, we have the psychological benefits. Getting yourself to a point where you're mortgage free, or even just reducing the term of your mortgage through overpayments, will create for many a great sense of freedom in their lives. And that's really hard to equate in terms of value versus say, oh, well, the stock market will provide a better return. Some people will just value that freedom far more than they will a greater return on investment through stocks. Okay, so now I want to look at some of the negatives of overpayment, starting with it isn't necessarily the best return. First of all, it's still widely believed that even at higher interest rates for mortgages, a consistent investment into the stock market over a long period of time will produce the best returns. If you have a mortgage of £220,000 on a 6% interest rate over a term of 30 years and you overpay it by £200 a month, you will save £82,636 in interest and clear that mortgage in roughly 22 years. If you invested the same amount and achieved a 6% return for 22 years, you would have £109,000. In this assumption, your mortgage rate would stay at 6% for the whole term of the mortgage. I think that's potentially unlikely, as rates might change, and also you'll get better access to rates as you pay off more of the mortgage, as we discussed. I did this example on 6% because of the forecast of where interest rates are going and because it represents a realistic return from the stock market long term. Obviously, if interest rates raise above that level, this relationship is tested. If you've got interest rates at 15% on mortgages, it's unlikely that the stock market's going to deliver that sort of return long term. So in that example, you would then be like, okay, paying off the mortgage is the best thing to do. But just to counter this, even if rates did go that high, you also need to consider the use of tax-advantaged accounts like pensions. UK taxpayers can claim tax relief on pension contributions, which could be as high as 45% tax relief, as well as the long-term benefits of investing, which could still provide a greater return than overpaying your mortgage. Next up, you lose access to your money. This one's really simple. Once you pay the money to the mortgage, it's essentially gone. You can't get it back without refinancing it, and that means then there's a lack of flexibility. What happens if you focus on hammering down your mortgage and paying it off, and then you lose your job? You could still be in a position where you lose your house anyway, because all of the spare money that you should have built up, you've thrown into your mortgage. You might have been better just putting that money to one side as an emergency fund, say, so that you could support yourself if you were to lose your job and continue to pay your mortgage. Another thing people don't consider is overexposure to property. For many people in the UK, the majority of their net worth is tied up in the value of their home. Now, the issue with this is a home, while you live in it, is a non-income producing asset. What that means is if you were to lose your job, that property will sink you. It won't save you because you need to continue to pay your mortgage. Now, I appreciate once you've paid it off, that's a completely different set of circumstances. But the idea and the concept of continually overpaying your mortgage may leave you overexposed to property, when really you should focus on building a portfolio of income-producing assets that can support you if you were to fall out of work. As well as this, it's just good diversification to spread your money around a few different asset classes so you're not overexposed in one area. The next thing is rates might not even be as bad as you thought when you come to remortgage. I think it's important to acknowledge we're unlikely to return to the low rate environment that we've enjoyed since 2008. And the consensus online seems to be that anyone remortgaging at the minute should look to lock in a deal because rates will likely rise leading up to 2023. But beyond that, nobody knows. And if the forecasts are correct and inflation does come under control, they could start ratcheting down the rates from then. So you could panic, overpay leading up to that, and then find your remortgage is actually not as grim as you thought. Finally, and I think this is a big one, the impact of overpayments might not be even that good. Because let's say your biggest concern isn't the best returns, but instead you're worried that when it comes time to remortgage, you're not going to be able to afford your payments once they shoot up. I just sit here and question how much of an impact making overpayments to your mortgage is going to have on the overall payment that you need to make on a monthly basis. If you overpay by 10% on the mortgage within a 12-month period, you've got to commit, say, £20,000 to the mortgage in extra payments, probably only to bring the payment down by a couple of £100 a month on what it was. Wouldn't it be best to have that cash sat there instead, so that if you can't afford the payments, you've got the £20,000 there, which can help support you making the mortgage payments across the term before you get to refinance again at hopefully a lower rate? I wanted to sit here and just give a definitive answer to this question, but I think we all know the truth is there isn't one. For me personally, I think if you've got a long time left on your mortgage, a mortgage represents some of the cheapest debt you'll ever get, even at the higher interest rates, and inflation and the appreciation in the value of the home over time will diminish the impact of the mortgage and the debt on your finances. But I can also appreciate that someone near the end of their mortgage might sit there and go, well, this guaranteed return in the short term right now is much better than the potential of the stock market over the next few years, so I'm just going to hammer it. And there's a lot of people there that will value the freedom of paying off a mortgage far more than they will the potential risk or return of the stock market over the next few years. Whenever we make a decision about our finances, we're unlike Sandra Bullock. We don't win both ways. We make a sacrifice. We decide to allocate capital to one thing, and that ultimately takes away from another. I can't sit here and tell you if that trade-off is worth it to you. For those of you who are still sat there thinking, well, I'm unsure what I want to do in terms of paying off the mortgage, etc., there might be another option that you could consider that might just give you the best of all worlds. Let me explain what I mean. I was having a chat with a good mate of mine. His name's Kiki. I met him the other day and we went out in Liverpool with another one of our mates. He's called Polly. We've all now come to the decision that we're never going to drink again. Now, when we weren't dancing to German umpa bands playing ska classics, we were pondering this point about overpayments between us. You see, Keeks recently bought a home and he is worried about rising interest rates and the impact that's going to have on his monthly payment when it comes to refinance, because he's currently on a pretty good deal. Let's call it, say, 2%. But he's also worried about committing all of his spare cash to overpaying his mortgage and the lack of flexibility that gives him in terms of if something was to happen to his job, etc., that he can't get the money back out of that mortgage very easily. So to combat this, he's currently saving cash in a high interest savings account at a rate that is higher than his mortgage. Not by much, like I said, he's on a 2%, and he says that he can get 2.5% on cash savings. I think he's using a company called Zupa for this. One benefit of rising interest rates is a better return on savings accounts, even if it does take these banks ages to trickle through the rates. They'll slap the mortgage rates up instantly. They'll pull them off the shelf at a sniff of the rates rising, but it takes months for them to trickle down the interest rate rise into savings accounts. So Kiki's now building up a pot of cash, so when it comes time to remortgage, if rates are sky high, he can make the decision to pay a lump sum off and to reduce the balance and get a better interest rate. Or if this all calms down and central banks bring interest rates back down, he has a pot of cash there he can invest in the markets or in any other opportunity that comes his way. And finally, if the worst happens and he loses his job, he can use that pot of cash to maintain mortgage payments while he finds work. Now, while cash is being eaten away by inflation, and that is not ideal, these times are heavily uncertain and no one knows what's going to happen. And at least with this approach, you're preparing for all eventualities. For me personally, stopping investing is never the answer, especially in the bad times, as this is often when the best long-term returns are to be had. But instead of letting the gravity of the situation weigh you down, get ahead of the decision, plan for it, and give yourself options so if the narrative changes, you can always pivot. Right, I know for a new investor sat here right now, they're probably thinking, why have I decided to start investing at the worst possible time ever? These 9% returns that everyone used to talk about seem long gone now. Well, you need to watch this video next. In it, I show why 9% returns have always been rare and never really been a thing, but why that is ultimately okay. Also, I get kicked out of first class on a train and I end up at a finance YouTuber's celebrity house. So yeah, enjoy that.